The 2008-2009 world financial crisis has significant effects on the economy of Spain. The financial crisis in Spain has generated very high unemployment, a massive deficit, and unexpected price level changes.
The European debt crisis has deepened. A day after Standard & Poor's downgraded Greece's credit rating to junk, S&P applied the same rating to Spain's credit.
Spain is a bigger concern for most investors because Spain represents 8.5% of the EU GDP as of 2009, whereas Greece represented less than 2%, Portugal represented less than 1.5%. So a fairly large country like Spain having some concerns, I think that now in a sense we're moving from the minor leagues up to the major leagues.
The downgrade for Spain and a lack of clarity about how much money Greece will really need unsettled investors again.
Global recession. Spain's unemployment level has risen to be the second highest in Europe, at around 20%. Spain has traditionally had high levels of unemployment, but before the crisis began, it was only around 8%. Why such a dramatic increase? The answer lies in the Spanish construction industry. During the first decade of the 21st century, up until 2008, there was a boom in construction due to high real estate prices. This caused a swell in employment. Workers immigrated to Spain from Eastern Europe, Latin America, and Africa. When the housing bubble burst in 2008, hundreds of thousands lost their jobs. Not only immigrants, but also the youth of Spain were hit hard. Stimulus programs by the government have largely failed to reduce unemployment. And now, in order to reduce a massive budget deficit and debt, the government is enacting austerity measures. This means increasing taxes across the board and reducing spending, neither of which will likely impact unemployment in a positive way. As a result of poor job growth and a slow recovery, workers are increasingly leaving Spain to look for jobs elsewhere.
About 5 to 10 years leading up to the financial crisis of 2008, Spain's inflation rate stayed between 2.5 and 4%. When the recession hit, the entire Spanish economy was flipped upside down. By July of 2008, the national inflation rate was at 5.3%. Interest rates and the unemployment rate were also skyrocketing. Because of these factors, loans were not easily given out and people were left with much less money. The Spanish people began to lose confidence in their currency, which resulted in a decrease in consumer spending. Although the inflation rate had risen to an extremely high 5.3%, a year later the inflation rate was at negative 1.4%. What happened? Spanish inflation rate directly correlates to the price of oil. When the price of oil is high, inflation is high. When the price of oil is low, inflation is low. Why is this? There are two reasons. Spaniards spend proportionally more on petrol and diesel than people in any other European country. Also, fuel taxes in Spain are lower than any other country in the euro area. Although Spain has made significant strides in improving their inflation rate in the past 10 years, Spanish inflation rates have historically been above the euro area average. Structural elements such as income convergence, decreased productivity, and a lack of competition has allowed inflation rates in Spain to rise dramatically. The lack of competition in Spain can slow down innovation overall. The absence of competition can discourage investment in research and development, which ultimately affects productivity growth. By having competitive agents in the different markets of the economy, Spain's inflation rate and overall economy can begin to stabilize.
From London's perspective, as financial markets demand higher interest rates on its debt, Spain, like a number of economies in Europe, is battling to persuade skeptical investors that it can continue to service its rising financial obligations. When foreign investors stay away, Spain has to rely on its banks for funding, and as Spanish banks themselves find it more difficult to borrow from investors abroad, they are turning to the European banks as their lender of last option. According to European Commissioner for Economic and Monetary Affairs Olli Rehn, Spain is on the right track, but concerning the year of 2011, it is essential to enact these new concrete measures. The biggest concern in Spain is that its funding problem will become too large. The investors, many of which are European banks, fear that it could lead to a restructuring of debt that would inflict losses on bondholders. Among those examining Spain is George Papamarkakis from the hedge fund North Asset Management LLP, which has long been focused on security issues in Europe. With Spain's weak savings, Mr. Papamarkakis says he expects the domestic economy to continue to suffer in November 2010. It will become more costly for Spanish banks to borrow money as the country's cost of borrowing increases. He said the elephant in the room is that the Spanish real estate market continues to be over-leveraged and hasn't corrected. Such a correction would have an impact on local asset prices and in turn on the local equity markets. Uncertainty over Spain's capacity to recover has increased the pressure on Spanish stocks and bonds. Its Prime Minister, José Luis Zapatero, had already hacked billions of euros from the national budget this year, promised that he will expose a tighter 2011 budget in the coming weeks. The King and Queen of Spain can even feel the pinch. In September 2010, officials at Spain's royal palace announced that the royal family, whose income depends on the appropriations from the government, were even expecting a slimmer pocket money next year. Part of what worries investors is the tremendous overhang of soaring real estate loans, the residue of Spain's collapsed property boom that languishes on the balance sheets of the country's banks. According to Wall Street Journal, it says that Spain could try to stimulate growth through tax cuts and spending increases, but it has already mounted enormous stimulus spending that swelled its budget deficit to 11.4% of GDP in 2009. And it would need to sell more bonds to raise fresh cash. Buyers of Spanish government bonds, spooked by the prospect of a Greek default, have already demanded higher interest rates. Spanish private and public debt rose an average of 14.5% a year from 2000 to 2008, according to McKinsey Global Institute. Total debt peaked at the end of 2008 at 4.9 trillion, or 342% of GDP, a higher percentage than the level in the US and the most major economies, except Britain and Japan. The Spanish government has announced plans, starting with tax rises and spending cuts this year, to slice the budget deficit to 3% of GDP by 2014, a program financial analysts have described as credible. It forecasts that public debt will crest at around 74% of GDP in 2013, compared with 113% today in Greece and Italy.
The only way for the Spanish economy and for Spanish-based businesses, not just Spanish-owned businesses, but also foreign multinationals operating in Spain, the only way to remain competitive is to increase productivity, because we cannot lower prices artificially through the exchange rate.
So increasing productivity, what does that mean in practice? It sounds like deflationary policy, is that right?
Well, it means workers and managers and pretty much everybody working harder. It means doing so without smarter. And it means doing so, working harder without necessarily getting paid more. And it means investing more in education, which I think has been or continues to be the problem, or part of the problem in the country. And it essentially means also letting the market operate and see which kinds of activities should really be located in Spain and which ones shouldn't. Remember, very few people actually know that in Spain the most important export category, besides tourism, right, which is big, just the same way as it is big in Italy or in France, the second most important category is automobiles, export category. And it is the number one manufacturing good that is exported. And of course, we have we're anticipating that there will be a competitiveness problem if we don't improve our productivity, let's say in the next 3 to 5 years.
Mm-hmm. So these are all long-term solutions, it sounds like. Mm-hmm. Spain's unemployment is 19.5%. Mm-hmm. GDP fell by 3.6% in 2009. Mm-hmm. They're suffering now. Is there anything that can be done more immediately?
There are no magic bullets. The only thing that, is, if you cannot devalue the currency, the only thing that you can do in the very short run is to try to reduce costs. The easiest way, of course, is by not granting wage increases or by even if companies, in the presence of high unemployment, if they could reduce wages, right, they could negotiate with their workers. The problem, of course, is that the labor market situation or institutions are not very flexible. So it's difficult to actually lower wages on short notice. So it's going to be a slow recovery. That is exactly the situation. Compared to the recessions in the early 90s, in the early 80s, or the one in the 1970s, this is going to be a slower recovery. And by the way, it will depend largely on the extent to which, particularly the rest of Europe recovers, because Spain's most important trading partners are France, Germany, Italy, the UK.
The economic crisis of 2008 affected the Spanish economy negatively in almost every way imaginable. Spain built up a massive debt, inflation rose to an unhealthy level, and the unemployment rate went through the roof. Cuts in government spending are one way to reduce the massive deficit Spain has built up over the past 3 years. Budget cuts, along with a decreased corporate tax rate, would create more capital for businesses to use to expand their operations by hiring more workers and increasing productivity. By hiring more workers, the unemployment rate would decrease and productivity would increase. More employment would cause an increase in consumer spending, allowing the economy to grow. Massive budget cuts, along with a decreased tax rate, are possible solutions to solve the economic crisis in Spain.